Welcome back to the channel, everyone! If you're serious about saving on your taxes, especially when it comes to rental properties, then this video is for you. Today, we're diving into a crucial topic that could save you thousands: mastering passive activity losses for tax deductions. Whether you own rental properties or you're thinking about it, understanding this concept is key to maximizing your tax benefits. So, let's break down exactly what passive activity losses are and how you can leverage them to your advantage. First off, let's talk about what passive activity losses are. Back in 1986, the government introduced rules that categorized your taxable activities into three buckets: the portfolio bucket for your stocks and bonds, the active business bucket for your businesses where you materially participate, and finally, the passive loss bucket, which is where your rental properties typically fall. This passive loss bucket is where things get tricky. If your rental property incurs a loss, you can't just deduct that from your other income like you could before 1986. But don't worry, there are strategic ways to navigate this. The first escape route is what I like to call the get-out-of-jail-free card. If your modified adjusted gross income is $100,000 or less, you can deduct up to $25,000 of rental property losses against your income. This can be a huge benefit. For example, if you have $90,000 in income and a $23,000 rental loss, you can apply that loss to reduce your taxable income, thanks to the $25,000 rule. However, as your income increases above $100,000, this benefit starts to phase out, disappearing completely at $150,000. So if you're under that threshold, make sure to take advantage of this escape route. Now, what if your income is above $100,000? Don't worry, there's another strategy. Escape number 2 involves changing the operations of your rental property. If you have other passive income, or if you qualify as a real estate professional, you can use this to your advantage. Imagine your taxable income is $200,000, and your rental property has generated $10,000 in losses for the past 6 years. That's $60,000 in total losses that you haven't been able to deduct because of the passive loss rules. The good news is those losses aren't gone. They're just trapped in what we call the passive loss bucket. You can unlock these deductions by either generating more passive income, changing the character of the rental, or qualifying as a real estate professional. For example, if you start using part of your rental property for your business, you could free up a portion of those trapped losses. This strategy can be a game changer if applied correctly, allowing you to offset your business income with your rental losses. Finally, let's talk about the last escape route: the total release. This method involves selling your property outright. When you sell a property, the entire amount of trapped losses can be released all at once. Let's say you have that same $60,000 in trapped losses. By selling the property, those losses are unlocked and can be deducted against your other income, whether that's income from a job, a business, or investments. The sale of the property is treated as if the passive loss rules don't exist. So, not only do you potentially benefit from a capital gain on the sale, but you also get to deduct those previously trapped losses. This strategy can be especially useful if you're planning to sell a property anyway and want to maximize your tax benefits in the year of the sale. To sum it up, the passive loss rules can be a headache, but with the right strategies, you can turn that headache into a tax-saving opportunity. Remember, the three escape routes are get out of jail free, change in operations, and total release. Each has its own benefits, and understanding which one works for you is key to unlocking those tax deductions. If you found this video helpful, make sure to give it a thumbs up and subscribe for more tax-saving tips. And if you have any questions, drop them in the comments below. I'd love to hear how you're planning to use these strategies. Thanks for watching, and I'll see you in the next video.